Great news, stop scrolling. This is episode 106 of the Masterclass that could change your entire trading game. I'm Stephen Cox, CEO of Share Navigator and a full-time options and futures trader. And I'm about to hand you the keys to my all-time favorite options strategy, the short put strategy. Why is this my favorite strategy? Because the short put lets you put the odds of profitability entirely in your favor. We don't just like this strategy at Share Navigator, we actively trade it and we've had an incredible 93% success rate with it. If you want a foundational income generating strategy that profits when a stock goes up, stays sideways, or even falls a bit, then you need to master this strategy. And we're going to teach you using a live example of SPY, the S&P 500 ETF. And just remember, this is for educational purposes only, and all trading involves risk. So let's dive in. Okay, so let's start with the basics. What is a short put? Well, a short put option or selling a put is a simple single-legged strategy. So when you sell a put option, you're granting the buyer the right, but not the obligation to sell you 100 shares of the underlying asset. We're going to use SPY as the underlying asset from here on in. On or before a specific date called the expiration date at an agreed price. And in return for taking on this obligation, we immediately collect a cash premium. So the key word here, folks, is obligation. We're entering into a trade that obligates us to have to buy shares if a share price falls below a certain level. The maximum profit we can make is the cash premium we took in. And in essence, the easiest way to think about selling a put option is that you're selling an insurance policy on somebody else's shares. And in return for selling that insurance policy, you're getting a premium in, just like any other insurance company. The primary goal of a short put option is for the option to expire worthless at expiry. This happens if the underlying stock price remains above your strike price at expiration. If the option expires worthless, you keep the entire premium collected, 100% of the profit on the trade's credit. Because of this, the strategy is inherently bullish or neutral. You want the share price to go up or at least not fall below our break-even point. Somebody who is more bullish on a stock might buy the stock, for example, or buy a call option. But because we're only limiting our profit potential to the credit that we're taking in, it's considered a mildly bullish to neutral strategy. So that brings us to the best feature of this strategy, which is its high probability of profit. So when you sell an out of the money put option, so that's a put option with a strike price below the current share price, you can profit in three different ways: when the share price rises, when the share price trends sideways, and even when the share price falls, so long as it doesn't trade below our break-even price. So the odds are literally stacked in our favor to win. And that's the example I'm going to share with you with SPY throughout the remainder of this masterclass over the next number of episodes. So just look at this chart of SPY. So at the time of doing this video, it's October the 30th, 2025, and SPY is trading at 680. So we could go in and sell the $640 put option. So literally we could insure somebody else's shares for $640. So that's almost a 6% fall from where SPY is currently trading at. So in other words, we could profit if SPY stays where it's at, if it falls up to 6%, or if it rises. We keep that insurance premium we're about to receive, and we're going to show you in that example. And by the way, our break even is even going to be below that 640 level, because don't forget we've taken in a premium, and that premium has to come off the strike price in order to establish our break even price. So SPY could fall even more than 6% and we're still making money. That's why the trade is such a high probability trade of being profitable. So with every option strategy and investment strategy in general, there's risk attached to it. So you need to understand what your risk is with a short put strategy as well. And in order to do that, we need to establish what our break-even price. So the break-even price is the strike price you pick minus the premium received. So we looked at SPY, so our strike price would be 640. And whatever premium we're going to share with you in the next number of videos, we take that off, and that's the break-even price. In other words, SPY could fall below that, down to that break-even price, and we wouldn't lose any money. However, if SPY did fall below the break-even price, our losses start to mount, and they continue to mount as the share price continues to fall. And this is why we much prefer applying this strategy to an index like SPY, where the traditional trading patterns are more established and they're less volatile than individual equities. So when you apply the short put strategy in individual equities, you'll probably generate more premium, but the risks are higher because think about it. We've often woken up someday and seen the share price, even of the best stocks in the world, down 10 or 15%. You don't tend to see that within index. And I'm going to share with you a study that I've done on the S&P 500 that shows you that 90% of the time the S&P 500 within a 4-week period is trading plus or minus 5%. So it stays within a trading window. And you can use that information to your advantage when you're applying the short put strategy. Okay, so that's it for the introduction to the short put strategy. From episode 2 onwards, we're going to use a specific example with an ETF like SPY and show you why using an index ETF can statistically improve your advantage when using this particular strategy. We're going to show you how to manage the trade, how to place the trade, and things that you need to look out for. All of that will be explained over the next 5 episodes. But if you would like to fast track your learning, please consider our mentoring service where I work one-to-one with you at your pace and in your time. And that's simply the safest way for you to learn about options and futures trading.